Hey guys, Freaky Front Ends here. Last week I recorded Dallas morning news. This week I'm going to do Air Canada. This is one I've kind of touched on similar. I've done pretty sure I did Spirit Airlines before. Anyway, I do just make this bigger. I do own Air Canada. Unfortunately, it's rallied, so the timing of the videos kind of sucks. I also picked up Frontier more recently, and it rallied, and I still own Save, the one I did a video on. And then I've talked about travel before. Sometimes it's kind of played out. I remember doing the Airbnb video. I don't remember doing Expedia. But really the thinking was that service is going to pick up, right? And that was kind of more consensus now, but that was relatively before most people started thinking about that shift. And we're seeing the demand there. One of the interesting things, though, is last year we saw the demand, but fuel prices were very high because of the invasion of Russia into Ukraine. Now we're comping that, so the demand's still high. Relative. Some people might say it's higher, depending where you are in the world. But we're also getting fuel prices down. So that's really the crux of the video today. Most people know what Air Canada is. It's just another airline. In Canada, there's really two. There's WestJet and Air Canada. There's a couple low-cost ones, but they don't own enough market share to really talk about. Like you expect, you're just your airline. Usually I don't hold airlines for very long. In the past, I rarely have. And this one I'm kind of on the fence about because it's kind of run for me, but I want to do the video today because I'm contemplating whether I should sell some before the quarter or wait till the quarter reports and sell some more after kind of thing. But I do like this company. It's probably still fairly cheap relative to itself, but we'll jump to the numbers anyway. So one of the things, they're putting record numbers. So a lot of people are obsessed with 2019 numbers, like finally getting back to 2019 numbers. And now we're at the point where the airlines are actually putting numbers past that. So just like Delta's call, Air Canada's also putting revenue numbers that are past 2019 levels. So no longer they're recovering, but they're past recovery. And that might not be yet in terms of traffic, depending on the airline and where they're going on their routes. But it is in terms of pricing, hence the revenue side. I remember I'm pretty sure we talked about load factors when we did Spirit. It's one of the things I always look at, because kind of how efficient they are with their planes. I can't remember if I explained exactly what it is. Pretty sure I have a formula somewhere I looked up. Yeah, here we go. So this is kind of how I view load factor. So it's really your number of carried passengers, the distance divided by the available seat and the distance. So really how full are your planes when they're flying. That's just my how I view it. So anyway, their efficiency's gone up year over year. So you'd expect this is Q1 numbers. So travel's seasonal. So Q2 and Q3. So the Q2 they're about to report, and Q3 are usually their big years, your big quarters rather. But anyway, you can see that going into it, the load factor looks pretty good, which means the airline's operating more efficiently and the planes are fuller. And you can see the average revenue per available seat mile, the total revenue per available seat mile, and then the cost per available seat mile. And so all these things, you can see the revenue is far outpacing the cost increase. And this can be impacted by fuel. So sometimes they'll back up fuel, and sometimes they won't. But you can see the trend is very favorable from a margin perspective. Now, the numbers aren't still good in Q1, but they are looking good for Q2. So we won't really go through Q1 numbers too much because Q1 isn't a great proxy for the full year because it's not the seasonal demand quarter. But you can see relative year over year, obviously way better. But again, you have fuel from that demand. But what we're going to see now in the next quarter, or what I think, is that we're going to see the EBITDA tick up quite a bit with a little bit higher, more demand. So we should see this EBITDA, like this is the comp from this is Q2 of last year. And they only put up 154 million in EBITDA Q2 last year. And I think they're going to destroy it even more than people think. And the year, like they only put up, I don't know what it was like 1.4 billion in EBITDA for the whole 2022 year. And they've already guided to put up 3.5 to 4 billion this year. And we'll talk about that as well. One of the things I've been trying to point out here is just the cost structure of the business. This is just operating expenses. And you can see just how driven it is by fuel. So you got 5.2 out of 16.7. So about a third of your expense is fuel. So wages are a part of it. And that's one of the things I got wrong with Spirit. So I underestimated the pilot pressure. As well as fuel, because I did buy it going into a place where I knew energy was going to do good. It's probably premature in hindsight. No, I'm never going to be 100%. All you can do is average in if the investment thesis holds, or find another airline or another way to play it without the fuel exposure, like the Expedias or the Airbnbs. Anyway, so now we're going to have the opposite. So we should see fuel actually come down with the demand even higher still. So we should see margin expansion. That's what I'm trying to say. Year over year, and partially you could say it's partially priced in, but relative to what it was in 2019, you could argue not enough. Here again, just another way to show the fuel as a percent of revenue as well. So one of the reasons why I'm so excited is because last year we had oil really, for the most part, from April to June last year, so Q2, you've had it pretty much over 100 that whole time. And now we've had oil pretty much for that whole time. Let's call it between 70 to 75, maybe 80 for a little bit at the beginning of the quarter. So we've seen a dramatic decline in oil prices, what should lead to lower fuel costs for the airline. And we've seen that they keep increasing their guidance, and I think they're going to do it one more time, but we'll see. The 3.5 to 4 billion number probably doesn't mean much to you in context, so we kind of have to go back and put it into context. A while ago, so here you have the napkin math of Air Canada, just the relative valuation. I'm basically comparing 2023 guide versus pre-COVID years. Ultimately, I bought it at 19, so now the relative to 20 pre-COVID doesn't look as good, especially when I factor in the debt and the extra share issuance. So when I bought it, it was around 3.5 times EV to EBITDA, which screened fairly cheap. I knew it was 10% cheaper than 2018. I knew 2018 was super cheap as well, so cheaper than a very cheap year. And then I knew it was very materially cheaper relative to where I was trading in 2019, right into the pandemic. Now, unfortunately, it's rallied, so the idea is not as good as I have to view things. So now, hence the video where I'm contemplating whether I should remove some position or not. Or maybe add if I think it's going to be even better beat than what the consensus thinks, which is, it could be, right? At least in terms of operating income. Depends on the free cash flow. But anyway, you can see that I'm basically saying we should see fuel go down 21.5 to 28.5 year over year cheaper. So, well, some of it's priced in. I think there's still quite a bit of room to go. Like, this could easily get to 30, right? One of the things I think I've talked about before is these bigger capital intensive companies, in order to bridge the COVID pandemic when they were forced to shut down, they took on lots of debt. And some of them also had to issue shares to keep afloat. That's how you finance your business, especially when your demand gets turned off so bad. So Air Canada's balance sheet did get shot up. Not crazy bad, but enough. You can see the debt shoot up by 7 billion, and you can also see the cash on hand shoot up by 3.1. So they had to obviously issue debt to fund their business during a period where they weren't getting any revenue, and they also issued shares. So while the company looks very cheap year relative to 2019, the EV to EBITDA isn't actually that much better than what the share price would look like. So, like, what I'm trying to say here is when you look at this, you can say, wow, it looks way cheaper than 2019, right? And it does, but a part of that is because the balance sheet got shot up and they had to issue more shares. So you have to keep that in mind when you're doing companies like this. And that'll be the same for other airlines or other capital-intensive industries that had shutdowns during COVID, like cruise lines. Maybe we'll do Carnival at one point too. That could be a fun one. Anyway, I'm moving pretty quick here. I just wanted to point out the passenger load factor. It was around 83.4 in 2019 and 2018. So we're already getting to pretty good passenger load factors, actually improving relative to 2018 and 2019. And we'll see if that trend continues or not in this next reported quarter. That'll be something I'm interested in. The planes, I don't think I saw the average age. Some of them are pretty good, but they've signed long-term contracts for these, right? So anyway, this is just a snapshot. If you want, you can save it. And then I think that's really the gist of it. It's a fairly straightforward play. They do, for some color from the call, they did say that they have strong advanced bookings for the rest of the year, so they have good line of sight into what their performance is going to be like for the rest of 2023. So that gives you some certainty into their guidance outlook. And then they also continue to reduce their or increase their EBITDA guidance because fuel's still cheap relative to what it was last year. One of the other things we've seen, and this showed up really well on Delta's call, it also showed up in Air Canada's call, and the premium trends. Premium cabins represent 30% of the total increase in passenger revenues just from the year ago quarter. And then it also represented a 49% of passenger revenue growth versus the Q1 2019. That's what you want to see, because that's your margin expanding per average customer. And we've seen this trend as the premiumization happens over time. That's also something I missed when I bought Spirit, was that trend to people spending more for a relatively premium experience for more comfort. I did find this one interesting near the end of the call. Basically say that Air Canada is currently overstaffed relative to 2019 levels. as they're trying to get more operational stability, believe it or not. Anyway, I view that as there's likely more fat to cut out as the business and the whole world becomes more normalized over time. We still kind of have this like equilibrium trying to be made after COVID, and it's obviously going to go up too high and down too high, and we're still riding that mean reverting with less kurtosis. I just thought that was interesting. Then there is always the pilot risk. So we just see WestJet strike a deal, 24% pay raise over the next 4 years, and then we saw Delta also sign a major deal for 34% pay raise. So these are obviously going to put pressure on the wage line. We'll have to see how they, because it's industry wide, it's likely that the whole industry is just going to raise prices. Probably already have. So we'll have to see how this actually plays out though over time. I think that's all I really wanted to show. It's kind of, the thesis is partially played out. I do think it could get cheaper. One of the things that's nice though is because the EBIT is so high, right? We're talking almost $4 billion a year, and the equity market cap's only 9.1. Once they get this debt down, we should start seeing the value of the equity increase. So that's really the play longer term. If you were to like just buy and hold this position for a long period of time, but right now it might be easier places to make money after. So that's what I'm thinking. That's the thought to myself, right? Because it has appreciated 30% fairly quickly. Just looking for other spots that might be easier where it's the EV to EBITDA is a disconnect, right? Like I knew 2018 was too cheap, so I was like, well, anything cheaper than this should be my entry, and sure enough, it did hit that. It went under 20. I think I was just 19, right? So I've already kind of showed that, and that was kind of why I bought it. So if it gets cheap again like that, I'll probably add. But right now, there's not a real, like, yes, I think it's still going to go up probably by another 10% or so, maybe another 20% if I'm lucky. But longer term, though, it could, right? Because basically, you're going to get all this EBITDA to pay down the debt that you had to bear during COVID, and that should make the equity side increase as the debt slowly gets paid down. So really just your typical deleveraging story. Wanted to get out before the earnings anyway, because there's a lot of talk about travel right now, because the demand is still so high this June, just like last June, and then June, July, just like last June and July. So anyway, it's still a fun one. It's still slowly playing out. These things tend to be longer horizon. But yeah, it has appreciated, so it's not as good idea as it was. It's technically a 33% less good idea than it was when I bought it. So anyway, there's Air Canada, and hope you guys have a great rest of your week.